over of options. Now, first we will carry forward the discussion which we had last week on a particular strategy which we suggested, particularly for the on the call side. What is the the butterfly option for on the 17.6, 17.8, 18,000, and we will see whether the same structure, what is the valuation now. With that time when we spoke, it was 17,626.30 last week. Now it has moved above 18,000. So let us look at the valuation and also look at what we can do presently. That means whether we need to roll over the option. So what do you mean by, first of all, rolling over of option? Now let us say you are buying a call option. Okay. Now the price either goes up or goes down. So what you do is you move to the nearest strike. For example, let us say you are now at let us say 18. Let us say you are at 18,000 levels. Okay, 18,070 or 80. So let us say 18,100. 18,100. Now what you do is that today, let us say the price is around 90 rupees. We will see what it is. Okay, so we are starting afresh today. So 18,100 you are buying at 90. So let us say tomorrow the price today, I think there seems to be US CPI data has come, and that seems to be now higher, and global markets are falling. So let us say the CPI data comes quite high, and we see the market sliding. Let us say you have bought a call option today at 18,100 for 90 rupees. Let us say it slides down to 17,900 tomorrow opening. Let's say we'll keep it this way. Okay. So what you do is that immediately you sell off this option. Okay. And buy the 17,900 option. So it could be tomorrow, means it could be the expiry for Thursday, or it could be the next week expiry. Let us say we have taken the price for this week expiry itself. So let us say at 17,900, maybe tomorrow it goes to say 30 rupees or so, let us say, because right now it may be at close to 0.4 delta, so 200 rupees it will fall. So that doesn't mean that it will come straight away to 10 rupees, but let us say 200 rupees from now, where it is right now. We'll look at the NSE option side. 18,100 now, approximately 18,050 to 18,100. So 18,300 is around 17. So tomorrow it may go down to, let us say it goes down to 10 rupees. Okay, so 80 rupees could be the loss. 80 rupees could be the loss, right? So then you again buy a 17,900 option. So tomorrow the 17,900 option, because of a 1 day time decay, today if it is 90 rupees, tomorrow it may be going at say 17,900, could go at 70 rupees. Let us say 70 rupees. But you have lost 80 rupees already. So 70 plus 80, 150. So now your break even comes to 79 plus 150. It becomes 18,050. Today, even if you have bought futures, okay, you will be at 18,050. You will be at 18,050, right? So in the case of a call option, in this case, now 18,100, if you are keeping it passive, your break even is 18,190. But whereas now we have moved it to 17,900 plus 150, 18,050. So now you are able to get it much closer. That is the you are able to get it closer or even below the futures price of what you would have bought today. But it is a call option. So anything happens further, you are not going to be at a loss. Okay. So this is rolling down the strikes. Rolling down the strikes is done by a lot of traders also, as long as the trend does not change. So we have to see what do you mean by the trend change. So first of all, let us say we look at the graph. So now it has gone up. Today it is at around say 18,070. Now let's look at the daily chart. So the trend change will take place if it goes below this high, that is 17,780. So if it starts to close below 17,780, we can say the trend is changed. Otherwise, we have to say the trend is still intact. Okay, the trend is still intact. And also, no, this is the first important support. Now resistance come to support right levels. The close is 17,955. So even tomorrow, assuming the first thing is that it falls below 17,955, it's a good chance that on the close it can be above 17,955. The close can be above 17,955. So what we are doing is that if there is a gap down, we are just rolling over the strike from 18,100, which we have bought at 90, to that level of 17,900, and let us see what happens. So whichever strike is closer, we are just rolling it down to that particular strike. We are just rolling it down to that particular strike, taking the loss in the case of a roll down of a call option, and then bringing down the break-even point, so that whenever the rally takes place, we will be with the rally fast. Now, if you look at the as we draw closer to the expiry, we will have some issues, because you will have a faster time decay. So tomorrow, let us say this 90 rupees becomes at 10 rupees or so. Then after that, whatever that you buy tomorrow will have a very, very fast time decay, because you are paying 70 rupees for 2 days. Let us say tomorrow the option price is around 70 rupees. So you will be paying for 2 days, you will be paying 70 rupees as a time value, which is a very, very high time value, right? So what you should do is that you should look at whether there is an alternate way of rolling down the strike, which comes through spread options and all. We are not going to discuss at this point of time, but you can just shift it to a slightly longer term expiry. So what you can probably do is that you can shift yourself to the 29th expiry, which at that time tomorrow the price could go closer to 200 or 210 levels. So you can shift it to that particular level, taking this particular loss and rolling over the option to the next expiry, so that the time decay will not be that much. Okay. So what is very important, first of all, what we need to understand is that if we get a call option premium, and if the price is going to fall more than twice the call option at any point of time, then the rolling down of the option is going to be beneficial. The rolling down of the option is going to be beneficial. Now put it the other way, that even if there is a rally, you keep on rolling the option at any point of time, even in a bull market, you will get some dip which is more than twice the option price. At some stage you will get, because even in a bull market you will see prices sliding by 2%, 3%. Sliding is possible. So today we have seen it. See here also, if you look at a couple of days back, there was a slide which came down from 17,764 to 17,484. Almost 300 rupees slide was there, and the 300 rupees slide is more than enough to roll down the option, and get a break even which is closer to the same futures price if you had bought at 17,764. What I'm saying is 17,764 if you had bought a futures and if you had kept quiet. Okay, what result that would have given? The same thing would have been given by buying a call option at 17,700 levels and rolling down when it came down to 17,450 or 460 levels. Now, if you had bought that particular option at the 17,450 or 460, and if you are today had this particular high or whatever levels, if you have rolled, if you have done the rollover there, then on any fall when you do again the rolling over, you will end up with a greater profit than the future. So the entire objective for us should be is, why rollover? So the first important thing is we need risk management, risk better than futures. One. Two is sometimes get a result better than futures. Even a result better than futures. How do we get it? Because in the course of the market upward or downward movement, when you get some dip which is more than the option price or twice the option price, you normally get a result which is better than the futures. This is a general theory that you can have as far as the rolling over of the option is concerned. And particularly even if it's a bull market, in a situation like this, you will always have some opportunities to come on dips, but the dip may not sustain for a long. Tomorrow also we don't know, the open could be like that, and the close can be different. Okay, because every time that we have seen in the present run up, every time there is a dip in the morning, we see the close higher than the open. Now let's say we'll go to the graph. See here also there's a gap down, and then it goes up. So many here also gap down, and then it starts to go up. So most of the time we have a gap up, gap down issues, and because of that we tend to get a result which could be better than the futures. Now, for example, here itself, if somebody had rolled it over, let us say somebody had bought a 17,710. So this was 19th August, and let us say you have done it for September end call option you have done. Now, in the course of this thing, let us say how many times on a close to close basis itself we add the price going up and going down. See here it was it went down up to 17,345. Then it went up to so we add a collapse which is from here 17,992 to 17,345. So we had a 600 point collapse, which itself now will make the options look better than the futures, because it has come twice than the option premium that you would have paid on that day. Then after that again, if you see, it went up to 17,725, and let us say we had rolled it over there, 17,725 to 17,125, another 600 points fall. So now we are going to get results which are going to be even better than the futures. That's what we are saying. Then up here, goes up, then comes down. So doing this rollover thing, when you do little frequent rollovers, by taking care of this up and down movement, so we must know where to do the rollover, right? So the rollover can be done almost every day at the close. Also you can do the rollover, because we can't speculate to what extent probably the market will go up or go down. So you can do it on the end of the day, or probably you can also look towards doing at some important levels like R2, okay, or some important support resistance level. So let us say we have an important support weekly basis. We go to the week state. So here this is 18,114. So today 18,088. So 18,100 is this is a place where probably some 18,100 is a important level of resistance. Then going up we will have 18,350 levels or so. So these are the places that can be thought for rollover. So now when it comes down also, we should do the rollover when you get a support place, which we got 17,377. Then these places, which is 17,000 odd. So these are important places which we should look towards doing it. Or we can look at some Fibonacci resistance and support levels also. And based on that also we can do the rollovers, some important Fibonacci support resistance zones. Also we can look towards doing some rollover of the option. So rollover creates some advantages. So instead of being passive, let us say you have bought a call option and you have not done anything. So vice versa, reverse side we will look at it. Today let us say 19th September for 15th September, you bought a 18,100 call for 90 rupees. Then the break even comes to 18,190. Now tomorrow if it starts to slide to 17,900 or below, then getting 18,190 before or 18,200 before Thursday, that is 2 days, is going to become remote. It's going to become remote. But suppose if you've done at 17,000, tomorrow you cut it and then do it at 17,900, getting 18,050 the next day is a possibility. It's a complete possibility. So that is what we should look towards. That is, we should for those who are getting and also the rollover is a remedy for those who are afraid of putting stop losses, because the stop losses, what happens is it gets triggered. Then by the time it gets triggered, then you see the market falling, and then there is an immediate recovery. There's an immediate recovery, right? There's an immediate recovery that takes place. Today also, if you look at it, the let's say see today there are days when you have a dip and then it starts to rise. So tomorrow also we don't know, probably there can be a dip which could be below 17,980, and on possibility there could be a close which could be above 17,970, 980 levels. So that can happen. So we need to what I say is strategize our thought process. So we should know what we want in the market, what is our personality, how do we take all these things. Depending on that, we should start. One strategy is rolling over of the options. So what do you mean by rollover of the option? Again, to come back, is that you go to the nearest strike. So why do we go to the nearest strike? Is in order to ensure that whenever there is a rise from that, because some place, the market will start to rise from there. So when it starts to rise from there, then you bring down your break-even point. You bring down your break-even point compared to the first trade that you did. So that is the biggest advantage. And second thing is, whenever you will always, in the course of a bull move or a bear move, you will always get a counter trend. You will always get a counter trend. A few counter trends you will get, which will be something like more than the option premium that you pay. Because if you see what is the volatility say in the market. So just for information, what does the volatility say in the market? The volatility says that the move everyday move could be something like 150 points on a, because suppose if you put a 15% volatility itself, IV is equal to 15%, then based on that you will have 1 divided by 2 into 15. So you will have to get 0.95% movement, which into 17,000. So we are talking about something like 165, 170 points is what the volatility says, that between a close to another close. It will says that 150 to 160 points is the volatility that is being implied by the implied volatility at a 15%. Now this 150, 160 points, that means over a period of time, if the volatility should be that some ups and down movements should take place of 150, 160 points. It can be one-sided also, but total amount of movement in a month should be 150 into 20. It should be 3,000 points. So 3,000 points you are not going to get definitely one way, right? You are not going to get definitely 3,000 points in one way to justify this 15% volatility. That means 150 points every day up. So there will be up and down movements. For example, even if you see in this period itself, in the last 1 month, because this is August 18th August, and today we are about 13th, 14th. So let's say 1 month period. If you see from this day, this is 17,992, and here it was even on a close basis 17,577. So almost 400 points. So 577. Then you have on a close basis. This is not much of volatility, because this is 577, and we have got not much of volatility yet, but 577, and then we have got a 312. So that means straight away from this place we have got a 17,912 to 17,312, 600 points. Now here it is 17,312. It goes to 17,772, 777. So 400 points. So here itself is 1,000 points. Now from here up and down movements, if you see 777, you got 542. So this is 200 points. So from 542 you got something like 655, another 200 points. So 200, 200, 400, and then from here you got from 655 you got so not much of movement, but from 655 right now 624 you got a movement which is around 18,000. So in the course right now we have accounted for more than 2,000 points of movement that has taken place. Tomorrow if there is a slide, so what we really want in this particular move is that there should be some counter move which is equal to twice the option premium. If we get it once or twice, then the rollover would have been quite successful, which we will normally get in during the course of any bull market rally also. We are likely to get that. So if that does not happen, if that does not happen also, then in that case, since you have bought a call option, if there is no dip, then you are going to make money. You're going to make money, because suppose 18,100 you bought call option 90 rupees, 18,190. There is no dip, and if it continues to rally, anyway you are going to make money, right? Only thing is you will make less money compared to the futures. That's all. So if you want to beat the futures, you should get at some stage a dip which is more than twice the option premium which you will get. So you have got an advantage of doing the option by rolling over the option continuously and reducing your time decay to a very large extent, because see, let us say when you do for the entire now for 19 September, for 29 September, right now 18,100 could be going at 220 or 230 rupees. Now that means 230 rupees is a time value. 230 rupees is a time value. So if you keep it there, and if the market comes and closes back exactly at 18,100, then you will lose the entire 232 rupees. 230 rupees. By rolling over on the option, you will come to the last. Now suppose if you have kept on rolling over, today it has come down to 90 rupees. Okay, then after that it may come tomorrow or day after tomorrow, so 70 to 4. So at the maximum you should bring down for the entire month the amount of time decay that you should need to get. If something should be only 50 rupees or 60 rupees, that you do it by automatically rolling it over every day by doing the automatic rollover, right? So at the end of the day you can do, or at some important levels you can do. Now we will just in the course of this now we will just review what we suggested last week. In the butterfly option, that time around 17,625 or 650 it was. So call option 17,600, 17,800 and 18,000, because that time the price was something like 175 rupees or 175 or 180 rupees for that week. So 17,600. So we said normally it doesn't go by more than 350 rupees, twice the call option price. So we talk about 360 levels, 17,600 plus 360, 17,960. We put it around 18,000. So that is why we chose 1:2:1. Okay, based on the likely close to be below 18,000 or 18,050 for the this week expiry. Now already it is 18,075. Now today, as things stand today, what is the premium that we paid? I think approximately 30 rupees, 30 to 33 rupees is what we paid at that point of time. 17.6, 17.8 and 80, we paid something like 30 rupees. So let us see what is the valuation right now for 17.6, 17.8 and 18.1. So 17.6 is now going at 491. This is 491 and this is 307. So 491. Okay, this is 307. 1800. Is 143. This is 143. So total value is, this is 2 times, right? So this is 491. This is into 2 is 614. This is 143. So 491 plus 143 minus 614. 491 plus 143 minus 614. So this value is approximately 20 rupees. So right now it could be let me say the buy side is 491 or yeah, 491. So 17.8 is 307 and 18 is 143. So it's around 20 rupees. So we did this around 30 rupees. So there is a loss of 10 rupees right now. So there is a loss right now is only 10 rupees. So what you can do is, you can just either wait and see. Now because there is a chance still that there can be some slide, okay, and it can still close between below 18,000. We do not know. So let us see. One strategy is to just leave it there, okay. Just leave the entire thing open. Let's not do anything about it, because that time we saw that the market should not close much above the 18,000, 18,050. So now it looks to be slightly stretched. So there can be some correction. That's what the volatility says. So we can even leave this open and probably look at the 25-30 rupees as the maximum loss that can come. Alternately, we can close this trade for 20 rupees. Okay, take the loss of 10 rupees. So that's what we are trying to do, the rollover of option. And what do we think right now? Let us say, let's say the opinion is 17,750 has to be is a very important level. So let us say we feel the close can be about 17.8. So let's say we try to move this market, move this from 17.8 to 18,000 to 18,200. So let us say what is the price in this. So 17.8, 18,000 and 18,200. Okay. So this is what we just now saw as 307. This is 143. Okay, and 18.2 we'll see the rate now. Eight into is 44. So this into 2. So you get 286. So 307 plus 44, 351 minus 286. So this is 65 rupees. Right now, if you do this trade, 17.8, 18,000, 18,200, it is now at around 65 rupees. 65 rupees. So the previous one we are taken, that is a loss of 10 rupees. So if you do this trade, then you will get 75 rupees, and it will be between 17.8 to 18.2, anything around this. But that's so we have to now assess whether it is worthwhile to pay 75 rupees for the 17.8, 18.2. Okay, to do the rollover. I would say not, because the maximum profit will accumulate 18,000. So 200 rupees is the maximum profit, and you would have paid 75, 125. So even doing the almost near the close also, this 18,000 will keep on giving some value if it is closer to that particular place. So I think the maximum profit is going to be quite restricted. So I think better that we let us see what happens. We took the call that it should not be more than 18,000, 18,050 by the end of this one. So we will wait. Now, as the present situation. Now let us say tomorrow, if there is a collapse, if there is a fall, then what we can do is this. We have done the 17.6, 17.8, right? 17.6, 17.8, 1:2, and 18,000. Right? So this 18,000, if you want, we can slide, because we don't expect between 17.6 to 17.8, it should not collapse much. So what we can do is that we can roll over this 18,000 down to 17.9. Tomorrow, if it comes down, if the market comes down, we can roll over this 18,000 into 17,900. 17,900 and pay the premium. In that case, if it starts to move up also above 17.9, at least definitely we will not have any loss. We will not have any loss. The premium would have recovered, and we would have made, say, the profit was from this is 200, this is minus 100 rupees. Okay, so let us say what the rollover cost can come tomorrow. Let us say it comes to 40, then 30. So even then, so there won't be any loss, there will be profit. And between 17.6 and 17.8, if it closes, we will make good money. So either we can keep this between 17.6, 17.8 and 18, quite steady. We can keep that. Okay. Now, alternately, what we could have done, there is another way of rule. So these are many methods of consideration. Now we did 17.8 and 18, right? So this is a sell and buy, because this is 1, 2 and 1. So there is one sell and buy here. So the sell and buy itself 17.8 to 18. Okay, 17.6 to 17.8. Let us say it has given the full money. Let us say 17.6 to 17.8 is given the full money, in the sense this is going at right now is 491, and this is going at 306. So we got almost 185 rupees. So only 15 rupees is the balance. So we are not going to get much between 17.6 and 17.8. Okay, 185 rupees. Okay, now 17.8 to 18, we have seen the price now at around, this is 306 and this is 143. So still this is 160 rupees or so, right? So 163 rupees or so is there. So what we can do is that since this has given almost a good profit now, 17.6 to 17.8, we can remove that and see, because 185 rupees we can just pocket and keep it. Because if there's going to be a sudden collapse between 17.8 to 18, we can see what is the difference and just roll it over and just give it off. Because since we have got already 185 rupees, the maximum loss that we can go make is, see, this is the 200 rupees. We have taken 185 rupees as the profit. Right now, if you do that, 185. So maximum loss 200 minus 185 is only 15 rupees, plus the option premium that we have paid is 30. So maximum loss is going to be only 45 rupees. Maximum loss is going to be only 45 rupees, and so we can see what happens. Maximum loss is only 45 rupees. In case if it is going to come down, then in that case we can make. So As per the thing, since we expect that there has to be some correction from 18,050 to 18,100, there has to be some correction. Since it has gone up to that extent, we can remove the 17,6, 17,8, 1:1. So that is what we have to do, because if it has given the full profit, almost there is a 15 rupees difference still is there, but it has given almost the profit. So we can take the call to remove this 17,6 to 17,8. We can remove. Keep the 17,8, 18,000 sell by alone static right now. Sell by alone static remain. And since we have got 185 rupees there, the maximum loss is going to be 200 rupees here. So the maximum loss is going to be only 15 rupees plus the option premium that I paid is 30 rupees. So 45 rupees is going to be the maximum loss. Okay. In the event of a slide tomorrow, we can see what this value between 17.8 and 18 will come and take the profit. So this is how normally you do in a butterfly, that you keep you do a trade, and then after it exceeds a particular level, just see whether this buy sell portion, the first one which is at a profit, whether that can be taken, hoping that there can be some pullback at some stage. In that particular case, no, you can always close this trade. Even otherwise, it's not going to make any big loss. Okay, so this is how you do the either the shifting of the position. You can call it either rollover of position, or you can call it as a shifting of the position. So what we have explained today now is the shifting of the position. And also we have said that blindly, let us say you are buying a option now 17,600 18,100 option at 90 rupees, and tomorrow you do the rollover on any dip. Let us say what the end result comes. That we will look at it on Thursday when we review this particular option strategy. Now instead of September 15th trade, you can also look at the September end, September 29th. September 29th trade, this one, because you can lose a little less on the time value. So 18,100 is around 240 rupees. 18,100 is around 240 rupees. But if you buy right now 240 rupees, then the break even comes to 18,350. 18,350 is the break even. So what we should do is that we should look at probably we should what we should do is that we should try to roll over. Suppose let us say tomorrow or day after tomorrow it comes closer to 17,850, 860 can be the 17,950 is one support. If it falls, then 17,850, 860 is another support. Then 17,750, 770. So that should not be broken. 17,770 should not be broken. The supports are coming at 17,950 and 17,860. So tomorrow, if there is a collapse because of what's happening in US market right now, chances that we may get a support close to 17,860 levels. 17,860 levels. So let us say at 17,860, we roll over this particular option, which we are now buying at 18,100 at 240. So we will keep this in mind. 18,100 for 29th. We are buying now at 240 rupees. And we are going to roll over tomorrow in case if it comes below 17,900. Let's see what happens. And the same butterfly which we did 17.6, 17.8, let us say we have removed it today. Tomorrow it comes between 17.8 to 81. Let us see what happens. Suppose if you are not removed today, and tomorrow it comes to 17.9, we are rolling down the 18,000 to 17,900 and see what is the result. And third thing, we just remain passive. Let's see what happens. Okay, so these three things will keep an eye for the rolling over of the options. Okay, so we will continue with this discussion of rolling over of options in future time periods also, and show the benefits. And so now we will just turn towards the present situation in Nifty and technicals. So it has closed at 18,070. So the first support now comes the same, this resistance come support level 17,965 or so. Then we have this is 17,925, but that low is 17,833. So sorry, 17,785. So this low is 17,889. So 17,850, 860 can be one support, because that is based on the Fibonacci. Let's draw the Fibonacci from this particular level itself. Okay, so we have the first support 17,945, then 38.2% retracement comes at 17,856, 50% 17,782, and that should not be broken. That 50% 17,782, we have to presume that should not be broken. Okay, so we should expect the halt to take place around 17,856 or so. So what we can do is 17,008, the any strategy that you have done already, please ensure that the butterfly structure, if it whatever it comes to profit tomorrow at 17,850, when it falls down, then whatever profit that you get, butterfly 17.6, 17.8, 18, please close. If you have then otherwise, if you have let us say if you have removed this buy sell leg of 17.6, 17.8, tomorrow you remove the leg of 17.8 to 18,000. Third aspect is we whatever we bought 18,100 for 90 rupees for 15 September, roll over the option when you get it 17,850, 860 levels. Then 18,100 option also, if you have done 240 rupees for September end, just also please roll it over when the market falls below 17,900. One. Now the fresh aspects is tomorrow it falls below 17,900. It falls below 17,900. Then in that case, what you do is that you buy at 17,855. Okay, 855, 860, and just put a put option below 17,700. Buy a put option below 17,700 for the remainder of the month, for the remainder of the period for September. Because probably we end up paying something like 100 rupees, under 110 rupees, and that can give you a break even of 17,955. And again, if it has to go up, we can take the profits. So generally speaking, anything below 17,750 is not a good thing. So be careful to put a put option at 17,700 in case if you are buying the futures at 17,855. Now the overall thing is that the market is not good, doesn't look good. US market is not looking good. Let us say we go to there's a gap down today. So it looks as if the last few days of correction seems to have ended here, and so right now it has fallen below this. So I think we should be quite careful about what's happening as far as the US market is concerned, and Indian markets can just follow suit there also. So we look at the weekly chart also there, and so I think we are going to suppose if the week closes lower in the next couple of days, then it will form a lower top. This is a top and this is a lower top, which is not a good sign. Now there can be some support coming in the US market in this trend line. Okay. So this trend line can give some support. Just 3900 support. But right now the fall because of the very high US CPI inflation, the fall is very steep right now. Okay. Okay. Now we will look at the Bank Nifty. So Bank Nifty generally is doing well, but I think this top 39,760 is the stop loss. So anything below 39,760, I think we need to wait, because don't buy immediately. So anything below 39,750 and 760, or the close on that day below this is so this is weekly close. So daily close will go for. So daily close anything below 40,070, or probably this particular level, which is 39,865. So 39,865, 810, I think should be the close below which I think the Bank Nifty has to be careful, and that is still around 1000 points away. That is still 1000 points away. But we need to be a little careful about this particular move. So having said this, last week also we said that the high to low range in any this one is approximately, most of the time it could be 3 times the option price. So 3 times the option price is approximately, last time when we did is 175 to 180 is the option. So 540 points is the normal weekly high to low. And if you look at the Nifty last Thursday, let's look at the Nifty of last Thursday. So last Thursday was 8th, right? So 8th September. The low was 17,000, 8 September, 1, 2, 3, 4. Right, so this is the 8 September rate. So 8 September, 1 week, that was a close. So that was expiry was on 8 September. So probably we can look at the 8 September close for 17,798, 17,800, right? So 17,800 is the expiry close on 8th. Normally what we should have done is, if we had waited for the Thursday expiry, 17.8, at the time the option premium could have been 150 or 160 rupees. So it should not close above, we'll say 18,100. So ideally what we should have done is that we should have done as 17.8, 18,000, 18,200, 17.8, 18,000, 18,200. That time if you had done for 30 rupees, today it is going at 55 to 60 rupees, 55 to 60 rupees, which can expand tomorrow. So not that it has not paid, the butterfly structure is also paid. If you get 1:2 or 1:3 profits at any point of time in butterfly, then in that case, even if sometimes it's going to be a loss, still we'll make some money out of that. Now, last week to this week, if you see, it was the 8th September, 17,691 is the low, and 450 rupees if we add, 18,150. So going much above 18,150 is something which probably doesn't happen much, because the volatility is almost, we can say, 3 times the range. I think we should be quite comfortable with this particular range which we have seen. So there can be some correction, after which we can see next week again raising by 400 to 500 points. So normally the week high low range in Bank Nifty is something like Nifty is around 450 points, 450 to 500 points. And if you look at the entire this particular month, for the entire month we have seen 17,150. So if you take 15th to 15th, this one, so 19th August, or even take 15th, let us say, the high to low is 17,166 to 18,000, almost 1,000 points. So we can say 900 points, which is approximately 3 times the option range, So normally, we have only 3 times the option range. Sometimes in some months only we get a very extraordinary movement that takes place, which is even more than 1.5 times of the option price range. Sometimes it happens. That happened, I think we can see the last this particular month we had a very spectacular range, almost 1,700 points. What should have been 1,100, 1,200 points? It was 1,700 points. But next month, if you see, it was 800 points, 17,992 to 17,154. Last month is on 800 points. So now we have seen 17,468 is the low till now in this month, and we are seeing 18,088. So something like 600 points range is there. So we should see some amount of movement still. Movement has to be seen. Which side is going to move is we have to wait and see whether it's going to cross below 468 or go up to 18,400 or 500. So if it falls to 17,850 or so, the bullish opinion can be kept for this one for a range which could be up to 18,400 or 500 levels. You can keep it up to that depending on the this particular volatility which we see right now. Okay, so that is if you put one indication that we get is the ATR range. There is average true range. So average range, if you see the last this one, average range that we are getting is something like 1172 points, 1150 to 1172 points. In some months it can be different, some months it can be more, sometimes it can be less, but average is 1170 points we get. So here also 16.7 to 15.2, 1,600, 1,500 points. Here we got 1,500 points, and in this month it was 17.1 to 15,400 points. So we are getting an average which could be 1,200 points, but right now no, we are getting a slightly higher range. In a falling market you normally get a higher range. In a rising market we normally get a slightly lower range. Okay, so 1,100, 1,200 points is what we can generally look forward as far as the Nifty is concerned. Now, depending on this, the rollover of the options can be considered. So one thing is that if you work with the butterfly itself for the week, okay, and do that very strategically in the sense, take almost in a falling market also, it doesn't normally go by more than 2 times the option price. So when we get a profit, we are going to get something like exceeding 2 times the option price. We are not going to so you keep the strike like that. Otherwise we should keep the strike in such a way that we keep it at 2 standard deviation. Like for example, last time it was 17.8. So instead of keeping it around 18,000, let's say we put it 18,100 or so. 17.8, 18.1, 18.4. 17.8, 18.1, 18.4. Probably the premium can be a little lower, but the profit can be more. So if you do the 17.8, 18.1, 18.4, I think most of them know that points which is twice the option premium, normally it doesn't go much above that. So even if it goes that, still we will have a profit. So mostly we can do that also. 17.8, 18.1 and 18.4 is what probably we can keep for a week. So going by that same logic, we will just see right now, of course the week has not closed, so on Thursday we will look at it. But for 22nd, if you look at the option premium, presently the market is going to slide, so we will not do the trade right now. But what I'm saying is if it is 174, then probably we can it should be 350. So instead of 350 we can keep 400 500 points. Let us say 18.1 to 18.6. if we do, then 174, then minus 21, it comes to 42. So 132 points is what we will get. Otherwise, if you keep 18.1, 175, 350 points, it comes to 18,450. Then we pay 90 rupees here. So it became 84 to 85 rupees we pay between 18.1 to 18,450 levels. So we will wait for some time and see to what extent we are we get the that is the downward movement, and based on that we will look at it. See, 1:2:1 we have to normally go, because if you do only 1:2, suppose if we do just a ratio spread, though we may not expect now the movement to be more than 18.1. If it is going to be 2 times, then 175 into 2 is 350. 18,450 is not likely to come, assuming we take that is on a close basis. So we do a 18.1 and then 18.35. Then in that case we will have no premium paid. Margin has to be paid, and probably we have to look towards whether there could be a loss which can come above the 18.5, 18.6 levels. Okay. So this all depends on the view that we have, the margin that we have, the psychological ability to face drawdowns. So these are very important. The safest thing is just do 1:2:1 without any loss, maximum premium paid, and just see how it can be rolled over, how it can be how intelligently it can be rolled over. That is one. Or second, just buy a call option and just keep rolling it over. You may still end up with a good result. Thank you. So any questions, please ask now. So thanks for your participation today.